U.S. stock market's higher until November 2018. Our research team at Technical Traders Ltd have been laboring over the recent market moves, attempting to identify if and when the market may be likely to turn lower or contract. We've been poring over all types of various data from numerous sources, and have concluded the following is the most likely outcome for when the U.S. stock markets may find a reason to pause of contract. As you read this research post, please allow us a brief introduction of the facts that supported our research. First, our research team started this investigative work after watching the Buffett indicator climb from the 2015 to 16 rotation levels to new highs, and achieve some recent news events. This indicator, being one of Warren Buffett's favorite tools for understanding market valuations in comparison to debt levels, provides some interesting components for our team to study. Yet, we believe this indicator chart lacks something relating to the global markets and the use of the debt capital to spur future global economic activity. Therefore, our team went off in search of something that could help us rationalize these high Buffett indicator levels in true relation to the global markets and in relation to the capital shift that we believe is currently taking place throughout the planet. The first component of our assumption about the global markets is that capital is rushing away from riskier markets and towards more stable markets. The second component of our assumption is that national debt obligations are being reevaluated based on perceived risks and contagion issues throughout the globe. The last component of our assumption is that the new U.S. president is shaking up quite a bit of the old constructs throughout the globe, and that the processes and policies put in place by President Trump are creating a very dynamic global capital market environment at the moment. When you consider these three components and their combined results on the global capital markets, we have to understand that there is a very strong possibility that the largest GDP-producing countries on the planet and their banking, institutional and investor classes are all operating within some aspect of these three components. This means there is a potential for at least $7 to $15 trillion, 10 to 20% of total global GDP, US dollars, that are actively sourcing and seeking secure returns while avoiding risks and debt contagion. This is a massive capital shift that is taking place currently, likely the largest the planet has ever seen. As the Buffett indicator is showing, the U.S. stock market is nearing or passing all-time highs in valuation in relation to U.S. debt levels. Yet, how does the Buffett indicator correlate the global capital shift that is taking place and equate these dynamics into fair value? The U.S. market, being the likely target of this massive capital shift, is a fair source for valuations comparisons, but we are experiencing a capital shift that has never before been seen at the levels we are currently experiencing. Sure, there have been shifts of capital before, but not at the $10 to 20 trillion USD level. If we compare the Buffett indicator to this Fred global stock market capitalization to GDP chart, some interesting facts begin to take shape. First, the peaks in 1974, 1999, 2008, and 2018 on the Buffett indicator are not as evident on this chart. The 1974 peak is relatively non-existent. The 1999 peak is a much more muted 28% peak, and on the Buffett indicator chart, and the 2008 and 2018 peaks are relatively correlated to the Buffett indicator chart. One should be asking the question, why are the two most recent peaks more correlated than previous peaks on this global capitalization to GDP chart? Our answer to that question is that after the 1999 till the 2000 U.S. market peak, the globe entered into a much more cooperative economic phase with the EU, China, South America, and many other nations operating as global peers versus global competitors. It was after this time that the capital markets began to sink in some form to the central bank's policies and the unification processes that were taking place throughout the globe. We should, therefore, assume that any global market contagion or crisis will likely take place in some measured form throughout nearly all global markets when it happens. Additionally, as regional debt or capital market crisis events occur in certain nations, capital that was deployed in these nations or capital markets will likely rush to new, safer environments for periods of time. Capital is always hunting for the safest and most secure returns, while attempting to avoid risk and devaluation. The central bank policies of the past 2 decades have allowed a massive increase in the available capital throughout the globe. global GDP has risen from $33.57 trillion in 2000 to $80.68 trillion today, a whopping 140% increase in only 18 years. Historically, global GDP has risen by approximately these levels every 15 to 20 years for the past 50-plus years. This is likely the result of the U.S. moving away from the gold standard and foreign nations following along with fiat currency central banks since after the 1960s till the 70s. This tells us that the peak in 2000 on this global capital market to GDP chart resulted in a moderately isolated capital market peak that was uniquely available within the U.S. and major economies, not globally. The 2008 peak represented a more globally equal capital market peak. This means the majority of the global capital market experienced capital appreciation. The same thing is happening right now. The global markets are experiencing an overall capital market appreciation that is a result of the past 20-plus years of central bank policies and economic recovery efforts. Stay tuned for part 2 next with charts and trading analysis. U.S. stock markets higher until November 2018. Part 2. Now, we are ready to share some new research that will help all of us understand the current and future market conditions given the ratios of the capital markets to GDP, as represented in our previous article Part I. The research team at www.technicaltraders.com believe we have identified a means of structurally understanding the U.S. capital markets in relation to risks or reversal and crisis contagion. As the Buffett indicator is now warning that the U.S. capital market may be nearing a critical price stop, we can now attempt to put this data into perspective in relation to capital flows and capabilities. Yes, in terms of historical price appreciation, we are now at or near levels that have historically been associated market tops and price collapses. Let us look at how the Buffett indicator has reacted at times using our new custom market cap volatility index. This daily custom market cap volatility index shows data from 2016 until now. It clearly shows the deeper price rotation near the elections in 2016 and the deep price rotation in February 2018. Let us compare these levels to the Buffett indicator reactions. In 2016, the Buffett indicator fell nearly 15% as the U.S. stock market indexes fell 13.5%. In February 2018, the Buffett indicator fell nearly 8.5% as the U.S. stock market fell 11.88%. Our custom market cap volatility index operates as a range of price rotation that assists us in determining if and when the price is outside normal price ranges. We are attempting to map price appreciation in relation to volatility in a historical form. When price retraces or contracts, volatility spikes higher. With this process of volatility increasing and price decreasing, the increased VIX levels will show up as very deep custom market cap volatility price corrections. The VIX will increase much faster than price will collapse, thus any price collapse will likely stay within these ranges or fall outside these ranges if the price collapse is more extended. Extended price collapses will result in much higher VIX levels while prices continue to decrease. If the price collapse is very aggressive, the increase in VIX will shoot higher and our custom market cap volatility index will crash to very low levels. If the price collapse is an orderly price decline, then the VIX levels will increase as price decreases more gradually, and the custom market cap index will likely stay within moderate ranges. At least we hope this works, as we are suggesting. Let us take a look at longer-term data. This weekly custom market cap volatility index shows the same day range as the previous daily chart. We should be able to see the blue channel levels that originate much earlier as normal price channel ranges. We have added a STD deviation channel to this chart originating from the 2010 lows that show the range as associated by the deviation ranges. This data tells us that U.S. stock market prices have recently rallied from near the middle of these historical channels and still has quite a bit of room to the upside. This would indicate to us that the U.S. stock market is not overly priced, and that capital is still working into the U.S. stock market in ways that support further price appreciation. Once price reaches above the STD deviation channel and above our blue price channel levels, then we would start to become concerned that prices may retrace, as they did in February 2018. Take a look at the rally from 2016 until now. Notice how the lows near 2016 represented a relatively depressed price channel range, with our custom market cap volatility index. In other words, prices were hovering near the lower channels with no real signs of risk as prices did not collapse below these levels. One correlation we can make with the Buffett indicator that may become evident in our custom market cap volatility index is that as U.S. bond rates increase, capital is usually moving away from the stock market and into treasuries. When we consider the past actions of the U.S. Fed and the correlations of the Buffett indicator to these central bank actions, we might find a direct correlation. Yet we believe our custom market cap volatility index is valuable for a number of reasons. First, we can use this index as a measure of price rotation and standard deviation low price identification. This will allow us to determine when prices are poised to form a bottom setup and when an opportunity exists for upside price acceleration. Second, we can identify when prices are nearing the upper channel as an early warning that prices may be attempting to hammer out a longer-term top formation, allowing us to reduce risk and scale back our positions. Lastly, we can look for cycles that may help us determine key dates for price rotation. This cycle chart highlights the deeper low price rotations in our custom market cap volatility index. These low points are when the U.S. stock market has seen increases in volatility and moderately deep or deep price corrections. Notice how the early 2018 price collapse is clearly shown as a very deep price rotation in our custom market cap volatility index. Notice how the 2016 and 2017 deeper price rotation on the custom market cap volatility index correlate with price rotation in the U.S. major indexes. Also, pay attention to the price appreciation that took place after these deeper price corrections. These cycles suggest that the U.S. stock market should continue to push higher for at least the next 90-plus days, till near November 2018. Near this date, there is a relatively strong likelihood that some type of deeper price correction will hit the U.S. markets, possibly a bit sooner or after this date. The cycle frequency and accuracy of these bottoms suggest that the price of the U.S. stock market will likely push higher over the next 30-plus days than possibly stall while attempting to form a potential top. It is likely that this top formation or horizontal price range will become extended consolidation before any deeper price correction begins. In the meantime, we believe the U.S. stock market will continue to push higher as our custom market cap volatility index shows. Our suggestion at this point is that the Buffett indicator is failing to correlate the global capital pool that exists currently, and is also failing to adequately reflect the capital migration that is currently taking place throughout the globe. We believe the U.S. stock market could continue much higher at this point, depending on how the global markets react to the shift in capital and the longer-term debt issues that are playing out. We certainly don't want to mislead anyone, so we are alerting you that November or December of 2018 appears to be a time where prices may rotate a bit more violently to the downside. This may be correlated to some type of global crisis event, or it could be an extended capital shift away from the U.S. stock market, where capital flees to new opportunities in other global markets. All we know right now is that the U.S. stock market is still on a path to move higher, and we still have quite a bit of room for market cap growth over the next 3+ months.